Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have my friend Tim Bergin. Tim is the founder of On Beyond Investing, and it's a subscription service that explores kind of value and deep value ideas across the globe. Tim, how's it going?
Good. It's a pleasure to be speaking with you, Andrew. I'm a big fan of your show, so it's cool to be a part of it.
No, I appreciate you coming on. And, let me start this podcast the way I do every podcast, and that's by pitching my guest, and that's you. I was telling you before we signed up, I've been a subscriber of On Beyond since at least the summer of 2018. So, I didn't sign up just to have you on the podcast or something. It's a pay for service. So if I've been subscribing for over 2 years, it's because I like it. But, it's one of my favorite subscription services. The world it seems is increasingly focused on momentum, growth stocks, especially US focused. And On Beyond, it kind of cuts against the grain and does one thing, and that's look for the most part, traditional value to deep value, good companies, kind of all across the world. So again, I've been subscribing for over 2 years at this point. Really enjoy the service, really enjoy everything. My one complaint would be, I kind of think you're a crazy person because in your last issue, we talked about you go swimming in 10 degrees Celsius water a couple times a week. I think that's a little bit under 50 degrees Fahrenheit, which is just wildly cold. So you're a crazy person. But all that out the way, Tim, why don't you give us a little bit of your background and how you came to start On Beyond?
Well, thanks. The cold water swimming is pretty cool. I suggest people check it out, but do it slowly and safely. Anyway,
so my gym, when we could go to gyms, they had a cold tub, and the cold tub it's like 50 to 55 degree water, and you would get in there for 5 to 10 minutes after your workout to recover. And like, I could barely stay in there for 5 to 10 minutes, and that would only come up to, right underneath my heart level. I can't believe you're going swimming in that. I'm sure you can do it, but it's just crazy to me.
Yeah, the movement makes it easier. Yeah, and it's open wide. It's kind of the element of just calming yourself down and, just kind of trusting the process. It's a cool experience.
Makes sense. But I'm sure our listeners don't want to listen to us talking about swimming in cold water. Why don't you give us some background?
Yeah, they can check out our new cold water swimming podcast if they want to do that.
Coming next week.
Yeah. So my background is I was studying math in university, specifically actuarial science. And at my university in Canada, the way it worked is like every 4 months you would alternate between work and school. So towards the end of my school, I applied and got a job at a Canadian investment bank, an investment bank of a large Canadian bank in New York. And as part of that, they put me on a bank credit prop trading desk.
Mm-hmm.
And this is back in 2005, I think.
The glory days.
It was the glory days, exactly. It was the Wall Street bank prop trading glory days. And so I stayed doing that for the next 11 years.
Okay.
And, we were a global trading desk. We had desks in all the major markets. And we were, I think, one of the bigger credit prop desks on the street. And over my 11 years there, I did a whole bunch of stuff. Like I traded interest rates, traded convertible arb, did long short credit, corporate bond versus CDS arbitrage, or what, it's not really the right word, but whatever. That strategy, capital structure arbitrage. And that was a great seat. Like you said, it was during the glory days. I was there through 2009 and kind of saw the implosion in the credit markets from a front row seat. That was pretty cool. Probably took a couple of years off my life, but it was fun. Moved up to Canada with the same bank around 2009, and then worked there for a bunch more years. Went to 2 credit hedge funds, and then I decided to quit to do my own thing.
Yep.
So for about the last 5 years, I just primarily been managing my own money, and as part of that, people would approach me every once in a while, friends and family saying, "Oh, would you manage my money?" And for various different reasons, I just wasn't that interested at the time. But I said, how about I just tell you what I'm doing? Like, I don't want to give you advice, but I'll tell you what I'm doing, what I find interesting, what I'm looking at. Is that be something you're interested in? And that's kind of what On Beyond Investing is. has become. So primarily now my clients are, people like yourself, small hedge fund managers, high net worth types. I originally thought it'd be more retail focused, but they don't, that just hasn't been who has found my stuff interesting. And what I'd like to think is, it's still the same. I just write what I like and what I find interesting. That leads me to various weird places, but that's kind of on beyond investing.
That's great. Now, in your background there, I heard 3 times credit, right? Credit prop tests, and then I think you went to 2 different credit hedge funds. And that's a little surprising. I knew a little bit about your background, but that's a little surprising because just when I think of all the issues of On Beyond, and maybe it's just recency bias or I'm forgetting, like most of them are kind of focused on good business, good solid business, stable, good outlook. There's not really a lot of, hey, look at this bond, or this is a quirky situation where I've looked through the loan docs and I think there's something a lot of investors like. How have you transitioned from credit to this kind of more value investment focus?
Well, I think there's kind of 2 ways of looking at that. So the first thing, a credit prop desk on Wall Street back in the day was kind of like a cheap funded way to buy credit. So it was kind of like almost an arbitrage, right? Like,
Yep.
If you buy a corporate bond and hedge out the interest rate and credit risk, and you can take out, 1% per year, that's not appealing to anybody unless you're a bank that can lever it and your cost of funds is 0.
I can't tell you how many times I've heard merger R people in particular say like, oh, like there's some Japanese banks, they've got prop traders who borrow at 0% cost of funding, and they buy every safe merger arb until the thing is priced at like a 2% annualized return because they can make that work because their bank charges them 0 for the funding.
Yeah. And it's explicitly back in the day, if you hedge your corporate bond with the credit default swap, like you could lever that 100 times back in the day because of the risk weighting was so low. But if you take a giant step back, there was ways to make that trade more interesting where you're actually buying options. Like, for example, if the company decided to make whole their bond, or if it was a convertible bond, if the company was bought, sometimes you could actually buy these super cheap options. So like you pick up a 1% spread that you fund super cheap, but if they get bought, then all of a sudden you make a really great return. Like that was kind of the thing. And so, I don't think the way I look at the world has changed. It's just, I think part of the reason I left the credit is I just wanted to go where there's better opportunities. So if you were managing like, European credit desk or whatever, like you're looking at 1% yields, tiny credit spread. It's kind of like, what's the point? Like, unless you've access to leverage, but then basically you're just selling options is my thing. You're just selling call options or selling put options. You're collecting the premium and hoping it doesn't blow up anytime soon. But that never really interested me. So I think it's more just like applying more of a credit analytical approach. So it's a consistent, I guess, philosophy, but applied in different markets.
Perfect. And then, I think that, again, this might be some recency bias here, and you certainly cover more than just these 2. But I think, especially this year, a lot of your focus has been on one of 2 things, either financials trading below tangible, especially trading below tangible book. And I think we're going to talk about a couple of those later, or commodity and mining plays. And I don't mean you're out here saying, hey, let's go buy gold or let's go buy nickel or something, but a lot of them have been, hey, there's this really cheap optionality buying this uranium miner or this miner of X or something. So those are 2 very different areas, right? Like, actually, I would say there aren't 2 more diametrically opposed areas, right? Because for the most part, if somebody's buying a miner, they're saying the Fed is destroying the currency, gold's going to $10,000. We got to buy the gold miners to get in. And if somebody's buying the financials, implicitly, they're almost trusting the stability of the system, right? So what's attracting you to the 2 of those? And how do you kind of bridge the attraction to the 2 of those?
Well, I think it kind of goes back to a point you said earlier, where I think you can break up the investment world, like taking a giant step back, into 2 types of people. There's volatility sellers, and volatility buyers. And the sellers are basically people, selling options, whether they know it or not, but they're making steady progress but the payoff is like, there could be a really bad event. So you make steady money, kind of like momentum. You make steady money, steady money, steady money. And, that's a nice positive reinforcement, but you're taking like large tail risks. And some people really like that. And then there's, volatility buyers where you don't mind paying a premium or taking near-term losses if you think you can make a really large payoff. And, I think people are mostly kind of born in one camp or the other, or they're taught very early in their career. I think I just happen to be a vol buyer. And I'm not saying one strategy is better than the other, but that's just who I am. And so, then I'm just attracted to situations where I think there's a highly asymmetric payoff. And in the case of uranium, which is pretty weird, it's just this situation where demand is going to exceed supply significantly, I think, and then the miners are so bombed out, it's super cheap. Like it's not.
Yeah.
And so if I'm wrong, it won't be the end of the world. Some of these things trade almost near cash. But if I'm right, then, there's a huge home run. And, that's kind of how it takes me to weird places. Like it takes me to oddball stocks, or it takes me to, sometimes it'll even take me to a tech company. Or even Charter, I think fell under that example. Like Charter, there was very little downside below 300 and you nailed it. And, I would put that in the same camp of vol sellers versus vol buyers. And that was just highly asymmetric.
Well, you're speaking my language anytime you bring Charter into. But I want to ask you what your favorite uranium. I want to ask you to give the listeners a free look and ask what your favorite uranium company is in a second. But let me push back on one thing, because you said vol sellers and vol buyers. And actually, what I kind of look at it is with the uranium, you're a vol buyer, right? These are super cheap at this point. I mean, a lot of them, as you said, are trading near cash or something. And you're buying, hey, I think uranium goes up a tad and I'm going to make a ton of money on these, or like there's a lot of volatility optionality in them. Whereas a lot of times the way I look at financials, even if they're trading under book, you're a vol seller, right? Like you're betting that these assets are going to be stable enough for you to eventually realize kind of tangible book value. And there's not going to be, a sit group or something like if something happens to their portfolio, it's never going to be where they have a screaming home run, right? Because they're only going to get paid par on their loans. You're a vol seller because you're hoping, hey, I get par and these guys are going to realize par and eventually like I get paid out close to tangible book. Does that make sense? Or do you think I'm thinking about that poorly?
No, it does, but I would bifurcate it. So banks that trade under tangible book, I think fit under two categories. And I kind of briefly touched on this in my last issue. And there's banks that trade well below book that you just can't buy.
Yep.
And that's your point, like where you're effectively betting on stability. And then there's banks that trade well under tangible book, but are fixable. So like if you look at a Deutsche Bank, that deserves to trade at a massive discount. And I wouldn't touch it and I wouldn't advise anybody to. But if you look at a CIT, it traded well under book value. However, if you dug in and you did your work, you realize that the reason it traded well under book and the reason its ROEs were depressed is because it had a huge cost of funding. So to the extent that they could upgrade to an investment grade rating, that cost of funding would drop massively. So, most banks fund somewhere between, 20 basis points and call it 60 basis points.
Yep.
But CIT funds at 160 basis points. So if you can see a path forward where that 160 converges to 60, all of a sudden, I think that's back in the vol buying camp to the extent that you could be comfortable that that's the reason it's depressed. It's not depressed because it actually could implode, although, there's always some probability that a bank implodes.
Yeah.
Whereas, there can be like super sick banks that, need stability in order to continue. Like it breaks down between fixable and non-fixable.
So I'm glad you brought up the Deutsche Bank because I actually did have a question from your newsletter on the Deutsche Bank example. But let me ask you on SIT. So One of the things, and we'll get to SIT group in a second, but just one of the things in general you said is, hey, they fund their loans at 160 basis points, right? And a lot of banks fund them, I mean, kind of at 0% these days, right? With a 0% interest rate. A Wells Fargo with their free deposits, basically, when they're not stealing their deposits or defrauding their customers. But you said, hey, if these guys can refi from 160 to 60, they're going to make a lot more money just because their cost of funding's gone down. And I definitely hear you on that. But at the same time, I've looked at a lot of subprime lenders, and the subprime lenders, they're always borrowing. The first thing I say when I look at them is I'm like, oh my gosh, like their cost of funding is 10% because no one wants to lend them, and their book is super volatile and everything, right? And yeah, these guys would mint money if they could kind of borrow at Wells Fargo levels or even Citigroup's levels, right? Like they would mint money, but they can't because no one's going to lend them to because their book's so volatile. So do you think like part of their cost of capital is actually like their book's just a little more volatile, or do you think the market was looking at the stability of their business wrong? Does that make sense?
Yeah, no, well, the reason for CIT is just legacy. So they filed for bankruptcy in 2009. They got saddled with, so to take an even bigger step back, in 2008, they were basically all unsecured market funded.
Yep.
They filed for pre-PAC bankruptcy in 2009, and they've over that time transitioned from 100% basically capital market debt funded to now it's like 10%. But that 10% funding still costs them 5%.
Yeah.
Right. So that's a lot of the difference there. And so there's part of it. It's just like they just have this legacy debt. They need to pay it down or refinance it. And it became a bit of a circle because, their unsecured debt was high yield. And the reason it was high yield is because, their earnings were low. But their earnings are low is because they had the unsecured debt.
Yeah.
But to your point about the lending side, I think you definitely have to take a deep dive. But on the lending side, the CIT just is more niche opportunities. So like their spreads are more like, they're getting 7% on their loans.
Yep.
So it's not the crazy subprime, but it's more smaller. So they do factoring, they do equipment financing.
I think
they do rail car leasing.
Yeah. Let's save Citigroup for a second because I do want to kind of focus on that merger and that situation in a second. And
Sure.
Let me just ask you a couple more on the background. So you mentioned Deutsche Bank, right? And Deutsche Bank to you has been an example of, hey, this is the type of bad bank where it trades below book value, in Deutsche Bank's case for 12 years at this point, and you avoid them, right? And I think you directly said in your article, you avoid them because you can Google and see like this culture is awful, this company is awful. And then another thing you said was, hey, look at Wells Fargo versus JP Morgan, right? Both of them traded for a big premium. And Wells Fargo, it turns out their culture was a disaster. And today they trade for a fraction of book value, right? And JP Morgan still trades for a big premium because they're a great run bank. And you said, hey, like this is why you don't buy the premium banks because you never know which one's Wells Fargo versus JP Morgan. And I guess my pushback to you would be, well, like with the benefit of hindsight, it's pretty obvious Wells Fargo was a bad bank, right? But nobody could have told you this 5 years ago. How can you say kind of right now that there's something that is a bad bank that's uninvestable? Does that make sense?
So I'm not.
You're saying right now, Deutsche Bank is obviously a bad bank. You can avoid it. And then you said Wells Fargo and JP Morgan, you can't invest in good banks because it could be a bad bank right now, right? Wells Fargo has proven that it became bad. But 5 years ago, no one would have said Wells Fargo is a bad bank. So how can you say like just with Googling things today, you can prove one is a bad bank or another? Like maybe the market is Deutsche Bank's kind of turned their culture around, or maybe JP Morgan is actually a bad bank. And 5 years from now, we'll look back and say it was a bad bank this whole time.
Yeah. Okay. So yeah, there's two things. So to go back to the good bank versus good bank. So my point wasn't that like you should never pay a premium. My point is just it's really hard.
Yeah.
And I think this goes for quality investing writ large. Like if you pay a premium for a good company and you're right, that's a great investment. My point is it's just hard. Like it's just hard to know, right?
Yeah.
Like, and so, Wells Fargo was the example. Everybody thought it was a premium bank. It turns out it wasn't. And then I guess I go on to say further that I think it's easier to determine between a bad bank and between an investable bad bank and an uninvestable bad bank. And I think the easier thing there is just finding a situation that's fixable. Like, for example, if there's a bank and they ran into problems in, one of their lending areas, then you can say, okay, that's fixable, right? And if they fix that, or, they have too many foreclosed homes on their balance sheet, if they sell those and put them in treasuries, I've seen examples like that. You're like, okay, all of a sudden their ROE approaches 8 from their current level of 2. It's like, okay, that would be what I call a bad bank that's fixable. Ran into an issue, but it's fixable. If you look at something like Deutsche, it's just their main business is tough. Like being a bank in Germany is super competitive, super low spreads. They tried to hold on as last investment bank standing. It really didn't work. They have too much capital tied up in their interest rate swap trading. And then if you look at the money laundering and you look at the the mismarking book scandals and so on and so forth, you can say, okay, there's an issue here.
Yeah.
So I guess what I'm trying to say is choosing between quality companies can be difficult. Some people are probably very good at it. I don't think I quite have that skill. So therefore, I think, you can buy a good company at a good price, but also you can look at a cheaply trading bank and determine if it's fixable.
Yeah.
I guess that's my point.
So I think what you're saying is, to you, an investable bank under tangible book value is a bank that they have an asset problem or they have a cost of capital problem, but they don't have a cultural problem. The difference for you is a cultural problem where it's just going to consistently repeat over and over and over again. Am I kind of interpreting that correctly?
Yeah, exactly. Like if you had a subprime bank, and all they did was subprime lending or subprime auto lending or whatever, and you just say, well, that's just not an area that I think is a very good business. Like those things habitually blow up.
Does new management change? So subprime agreed, but does new management change a bad bank becoming investable? I think of Wells Fargo. They're on their third CEO in the past couple of years, or Deutsche Bank. They're bringing in a new CEO every 2 years. It seems like Wells Fargo, they're not in bad businesses, right? Can that become an investable bank at some point?
It probably can.
Yeah.
It probably can. I haven't spent too much time on that, but if I think of some of the ones I've invested in, like CIT, actually, they changed CEOs a couple times, and every time the change has been positive. I think it depends on their mandate. Like if they're, like for example, in Deutsche Bank, they came in and their CEOs would say, "We're going to double down on investment banking." It's like, no, nobody wants you to do that except for probably your executive chairman. But if they come in and they say, "Okay, we're going to cut costs and reduce risk. We're going to be, reduce risk culture." I think that can make sense. But yes, I think it has a lot to do with culture, I think.
I realize it's a little bit of a niche discussion, and neither of us are Wells Fargo experts, right? So we're kind of talking, but Wells Fargo is just one. It stuck with me so much recently because 10 years ago, Buffett's out here saying whenever I make an investment, I compare my cost of capital to just buying more Wells Fargo, right? And Wells Fargo is probably trading at 2x book value then. And then you fast forward, 13Fs came out 2 or 3 days ago, and Buffett's selling basically his entire stake in Wells Fargo at 60 or 70% of tangible book value. And it's one where I look, A, how quickly kind of things can turn on that, but B, it does scream to me when you're paying that premium, there is something to that. There is some risk you're taking that you assess something as that good business, and it turns out the gold standard of investors has been doing that for decades, and he was kind of wrong.
Yeah. And I think in my last issue, I go into why, I can totally understand, Wells Fargo, the highest fee income, huge margins and less risk. And so if you have less leverage, less risk, high returns, wow, that sounds great. And I think what I was getting at with the Wells Fargo is it's kind of a cautionary tale, I think, for tech investors writ large or quality investors writ large, where it's you can spin these narratives about, it's a great and they're going to take over X and do Y. And it's always good to pay up for quality. And it's like, well, yeah, if you're right, like that's, if you pay up and you're right, then your returns can be enormous. But if you pay up and you're wrong, your returns can be a disaster. And I guess all I'm saying is it's tough. Like Buffett got it wrong in Wells Fargo. And he's the greatest investor of all time. And so, if you went back 5 years, differentiating, or 7 years, differentiating between JP Morgan and Wells Fargo was not easy. If you picked JP Morgan, you did very well, and you were right. They are probably the best US bank by far. And if you picked Wells Fargo, you were wrong. And figuring out you were wrong would have been difficult. Like I wouldn't knock anybody who made that mistake. That was a hard one to figure out.
It reminds me of one of the first podcasts I did with Bern Hobart, where we talked about, hey, which FANG would you bet against, right? Like right now, they all kind of seem undefeatable. Maybe Netflix, you could imagine it, but like nobody wants to bet against Facebook. Nobody wants to bet against Amazon. Nobody wants to bet against Apple. But history shows one of these guys is going to fail at some point. And when they do, unlike kind of a Wells Fargo, where there's a lot of tangible assets behind that, like when you buy Facebook, you're really buying that earnings power, right? And that earnings power can drop really, really fast if you get it wrong. And not that I would bet against Facebook, but history shows one of them probably does crack at some point,
Well, as you know, I'm skeptical of some of those companies. Like, not that I'd short them, but I think on the tech thing, I think people also, there's a very specific path that the world went through where antitrust was just wrong. Like, where would Facebook be trading now if antitrust said, no, you can't buy Instagram?
That's a good question.
Right? Like, people would be like, oh, it's a dying platform, older demographic, so on and so forth. And I think with some of these like winner take all bets people are making, I think they're implicitly saying, well, whatever my company X is going to be able to buy the Instagram of their industry. And I think the winds have totally changed on that. I'm highly skeptical of all of these these companies.
It's a great question, but at the same time, and again, neither of us are tech experts, but like when Facebook bought Instagram, people were mocking Facebook. Like Facebook bought Instagram for $1 billion. They had 39 employees and no revenue, right? And if antitrust had stepped in and blocked that, like who's going to buy what? Who's going to buy what, right? Like there was no market there. Like no one can buy anyone if you're going to block that thing, or no tech company at least can buy anyone if you're going to block that. So
totally agree. And I was one of those people who were like, wow, that seems crazy. But I guess I mean to say is like the next decade won't be the same.
Agreed.
Right. So the next decade, they won't be able to do the same thing. But yeah, that's getting a little out of my.
Yeah, I'm with you. And I want to talk FCNCA Citigroup merger. But before we get there, real quickly, we mentioned uranium. Let's just give everybody quick. What's the one uranium stock people should not invest in, because we never make investment recommendations here, but the one that you think is the most interesting that people should be spending some time researching?
Oh, man. I guess in my last issue, I'll throw it two. So one, if you want to talk about like quality companies, there's one company in Kazakhstan that just dominates the market, 40% market share, lowest cost provider. Usually that means enormous premiums. They don't have it. And it's actually quite cheap. So that's the easiest. And
what company is that?
Kazatomprom.
Kazatomprom.
That's just the easiest, safest, and it's cheap.
Do they trade on a Kazakhstan exchange or a U.S. exchange?
No, they trade in London. Okay. And the sovereign wealth fund owns, I believe, 75%. And they're market focused, and they're starting to change from just like produce as much as you can to maximizing returns. And so if that works, it boosts the whole uranium market, and they should do quite well. And then there's an interesting company traded in Australia, but it's American, called Peninsula Energy. It's kind of funny that they have a sales contract. Usually uranium sold on long-term contracts. So they have a long-term contract, even though they don't have an operating mine. And the contract struck at $52 a pound, and uranium trades at 30. So in the meantime, they could make that spread to help fund as they change their mind around. Mm-hmm. Longer discussion, but I think that's, between the cash they have and between the value of that contract and, if their new mine works, which I think it will, but I could be totally wrong. I think that's one of these asymmetric opportunities.
Perfect. All right, so let's switch over and talk about First Citizens and CIT Group. We've obviously already talked about CIT Group a little bit, but these two announced a merger. I think it was exactly a month ago. At this point, the market, part of it's the market just screaming higher, but part of it is the market loves this merger. I think First Citizen stock is up like 40% ish since they announced the merger, so that's always pretty nice. But why don't you take us through? First Citizen was one of your recommendations this month. What do you like about First Citizens? What do you like about the merger? How did you approach this company?
So First Citizen is kind of like, if you or I saw an investor doing something really interesting, you're like, I'm going to pay attention to them. And First Citizens buying CIT kind of made me say, oh, like I didn't really know the bank prior to the deal. I actually always thought a Canadian bank would buy CIT. And so when they bought it, I just said, wow, that's somebody interesting doing something smart. So I'm going to dive in. And so it's a bank based in North Carolina, mostly owned by a family who's run it for, I think, the last 100 years. Very good returns long-term and really good returns since their CEO took over, even, 10% annualized since 2007. And he's largely done this through acquisitions.
Yep.
So CIT will be their 21st, and acquisitions has been a really good strategy because you had, banks trading well under tangible book, small, mostly ignored banks. Then you get cheap financing to purchase them and then fix it. So it's, they would fall under, good banks but subscale, or good banks but, they have an issue that capital would solve. And so over that period, basically book values tripled, but they've also reduced shares outstanding by 7%. And the reason the market really likes this deal is, as we were saying before, CIT has a high cost of financing. First Citizen is a BBB plus rated bank. CIT is a high yield bank. This will all of a sudden boost CIT to an investment grade entity. They can refinance their debt, and all of a sudden that falls directly to the bottom line. And what really interests me about this deal, and I've invested in CIT on and off for last decade, and lucky enough to own it when this deal was announced, is that before I looked at the presentation, I just started modeling out numbers myself just to see, I wanted to compare what I thought to what they were going to present. And, if you all of a sudden just said, okay, reduce costs by 15% and reduce cost of funding over time, and take into account that, both have decent commercial real estate exposures and they'll probably see losses there. It was easy to see how this combination was going to look at an ROE of, 12%, somewhere between 10, 15 if you're super bullish, but 10 to 15%. And CIT was trading at, 64% of book, and even the combined entity now, even though it's up 40%, is trading at, 92% of book. So First Citizen, to kind of recap, 44% family owned, trading at 92% of book, assuming the deal goes through. And you're looking at ROEs of 10 to 15%, depending on what losses they take on their commercial real estate. And hard to say what that's going to be, but that's a wide enough, positive enough band for me to be interested in. And they're only talking about cost savings of 9%, which seems pretty conservative to me. So if you look at the track record, you look at everything like that, you look at how smart this deal is. It seems really interesting. And to take a big step back, when interest rates are so low, there's really only two things banks can do. They can cut costs, and they can lower their financing costs. And you can do both by gaining scale. So to the extent you can massively increase scale, because these banks are very similar size, you can buy a bank that you can fix. CIT gives them much more niche, higher spread yielding areas of opportunity. It's just a really smart deal. And I think it's applicable on a bigger scale, as rates are zero, and banks, a lot of banks will have 3 times their equity in just marketable investments.
Yep.
As those yield close to zero, that used to provide them, when rates are at 2%, that's 6% of ROE. That 6% has gone to zero. So, you have to do something like this in order to produce the, 10% return on equity that the market wants. And this seemed like a really smart way for First Citizens to do it. And so, the day the deal was announced, I just bought First Citizen shares.
There you go.
Well,
40% on them in a month, not bad.
Well, it felt dumb at the time because it was trading up 12% that morning.
Yeah.
But whatever, I was like, I don't care. It's still super cheap. And then, and it's also good to be investing with people that seem to be doing interesting things. And I think this definitely falls under that category.
No, it's funny because First Citizens, I've followed both First Citizens and CIT kind of out the corner of my eye for a while. And it's funny that, I don't think anyone ever mentions them, but they're this good, solid bank. As you said, they've grown through acquisitions. I think they've done a really good job. And the morning they announced CIT Group and it's, hey, we're using our stock, which trades at book or maybe a slight premium to book, definitely a premium to tangible book value, to go buy CIT Group for what, 60% of book value, something like that?
I think it was even lower. I should have it here. I think actually they sold it below book, but it kind of didn't matter.
Yeah, but
they're buying CIT at 37% of book, and they're selling stock at 84.
Yeah, so we're doing this hugely accretive transaction, and by the way, all of the everyone knows mergers, revenue synergies, very difficult to get in mergers, right? But cost synergies, when you're doing a kind of when you're doing a strategic merger, cost synergies are certainly achievable, right? Especially for banks. There's a lot of these duplicative costs you don't need when you merge 2 banks together. So I think they're doing a deal that made a lot of sense, and they were doing it at a valuation that made all the sense in the world. And you're the first person I really heard mention hey, this is a really gosh darn good deal. And obviously, it took the market a couple of days to catch on, but the market started to catch on. They bought 2 banks that were at the kind of lower end of the efficiency ratio for banks and ROA for banks and stuff, and they're gonna take them median of the pack, maybe a little bit upper median of the pack, and I think it'll be a really interesting deal.
Yeah, if you wanted to be super bullish and say there's a vaccine and CIT's losses are going to be pretty minimal. We went through a liquidity event and perhaps not like a bankruptcy type event. They're buying, even after their shares have rallied, they're buying CIT at 64% of book, but CIT's ROE could be 18% with 50 basis point cost of funds, and that's not going to happen overnight. But it'll happen in 2-3 years. So it could be a monstrous return for them. Yeah,
buying something with an 18% ROE for 40% of book tends to work out pretty well.
Yeah, exactly.
If that actually happens.
And even if they only get 10%, it's a pretty smart idea. And so investing alongside smart ideas usually works.
A lot of CIT, a lot of their lending in their franchises, you mentioned some of them, but a lot of them are commercial business, are in the commercial. I think they used to have a big franchise lending group. I think they've got a lot of ABL stuff and everything. Tell me if I'm wrong on any of this.
I think that's right. Yep.
Yeah. So, but a lot of these places are areas that tech startups like a Square or something are trying to figure out ways to move in. Do you worry that they're kind of going to get outcompeted by these tech startups and stuff that are moving in aggressively, very cheap cost of capital because they're raising money at huge valuations, and they do kind of own that relationship, right? I'm just thinking if I own 100 McDonald's and CIT comes to me and says, hey, let us loan you, money at 4% for your next restaurant. I might say, no, I'm just going to go with Square or something because I do all my POS through them and they offer me the same thing. And it's just a lot easier to have it all wrapped into one. Does that make sense, or am I missing something there?
Yeah, definitely. And there's some, I think, healthy competition. I think whenever I've looked at these, like a good example is the peer-to-peer lending.
Yeah.
It really didn't work.
Yeah.
And the reason it really didn't work is, and I had some money in some of these platforms just to see what it was. And the reason it didn't work is kind of twofold. One, you need deposit funding, right? It's really a low cost funding.
Yep.
Like you can't compete on spread if I can borrow at 40 basis points or lower. And maybe they have an equity, like a massive amount of equity now, but that's not always going to persist. And two, you need somebody to deal with defaults. And I think that's the thing that they always messed up. It was actually interesting, as I always think like a Goldman should buy a peer-to-peer lender and then, finance it with some of their, provide like some funding to the platform via their deposits, but then also offer that to the retail clients and then say on the back end, we'll try and maximize recovery.
Yeah.
I always thought like a peer-to-peer lender should be like, rather than, just put your money in, the brokerage your bank offers.
Yeah.
You could also put it into like a peer-to-peer offering that your bank services.
No, I hear you. And like, again, I hear you because Lending Club is obviously one everyone thinks of, right? And Lending Club's whole pitch was, hey, we're going to be the platform to match people who want to lend money to consumers with consumers who want to borrow money. It's like, that platform kind of does exist, right? Like you've got credit card debt out there. You can borrow against your credit card. Like it's tough because what they're really just doing is giving people, they're matching the riskiest borrowers who can't borrow anywhere else with the people who are willing to fund them the cheapest. It wasn't great. But when I look at something like this, like it does strike me as Square owns a customer relationship. Like they can do a lot of really good credit underwriting because they see the cash in, cash out every day, right? Like they see the receipts and everything. So I do wonder if like the people who kind of own the customer relationship that directly have a little bit of an edge there.
I certainly like that. That's a good example. But then, what about the guy who just owns his own burger restaurant?
Yeah.
Right. Like, and then, maybe a CIT who sends in a loan officer that can appraise the property.
Yeah.
Like they have an advantage over just like having the credit expertise. Like not everything can be automated, I guess is what I'm trying to say. And so, yeah, there can be scale advantages that these tech providers can do when they're, when they have the data that you suggest. But there's still tons of areas where that doesn't quite work. I actually do think a lot of these, fintech technologies would actually be awesome within a bank.
Yeah.
And I think, and this is kind of skipping ahead a little bit, but part of what I think we're seeing, and part of why I think banks are so interesting over the next decade is, they've had to invest in tech massively over the last decade because it was really one of their only functions to cut costs because they still have to, for the most part, maintain their retail branches. And as a result of that, like, I think they're embracing technology like they really didn't. They're super slow to adopt. And I think over, specifically the last 5 years, I think that's changed. And I think you could see more efficient banks. Because imagine like, if a bank can achieve an 8% ROE now, or even 10% with interest rates at 0, and interest rates even go up to 2% for overnight, like they're going to be supremely profitable.
Yeah.
And I think that's kind of what you're saying in terms of like, there'll be more competition from fintechs, but I also think the banks will have massively benefited for these tech advances in their areas. Yeah. At least the banks that are willing to take advantage of it.
Especially, I think this would be for a larger bank than kind of First Citizens, but for the largest banks, I think I've heard Jamie Dimon say like we employ as many coders, as many software engineers as some of, probably not like a Google or Facebook, but the tech companies one rung behind them, they employ just as many software engineers as them, Mm-hmm. And I do wonder, like, if you look at JP Morgan and you say, hey, I've got the Chase app on my phone, right? And you look at the valuation a JP Morgan gets versus the valuation a Square or one of these guys gets, you do have to wonder, like, is there a world where 5 years from now they're spinning out their online startup or something, and they can achieve a huge valuation because they certainly have the tech, they certainly own a lot of customer resources and relationships. And again, I'm just kind of spilling here, but you could paint me like a super bullish future where there's these huge hidden assets inside. I think it'd be one level up for Citizens, but where there's these huge hidden assets inside of them.
Well, or even, to skip ahead, we're going to talk about Irish banks, but some of the ones I look at, they talk about cutting costs 20 million, 10% per year. But they're taking those costs and investing them right into tech.
Yeah.
So like, streamlining processes, apps, providing, AI for loan approvals, so on and so forth. So I think, a lot of these things will be best served in banks because they do have the lowest cost funding. There will be niche opportunities, but I'm highly skeptical too of, more on the insurance side where we have all the data, we'll price everything better. It's like, wow, the other industries have lasted pretty well for the last 100 years. Like, I don't think that's right.
Yeah. Look, if you look at the oldest businesses in the world, I believe most of them are attached to some type of insurer or bank, right? Like those are, you think of something like a Bank of America. It dates back to, I think, Alexander Hamilton founded one of the forebearers of Bank of America. Like these banks often have roots that are 200, 300 years in the past. And there aren't a lot of businesses that do that. And sometimes when I look at these banks trading for below tangible book value, I say like, hey, you're kind of betting against the future of a business that, we've got literally centuries of these guys exist and they can survive through some pretty trying times and a lot of technological revolution.
Well, exactly. And the other thing to say there too is this is like the only decade that's ever had negative interest rates in the last 5,000 years.
Yeah.
So, and negative interest rates for the most part kind of breaks banks. So, I think people say, oh, banks are low, because of tech and so on and so forth. I think it's just as simple as interest rates. It's just much harder to make money. And so not only are you betting against, like you said, the 100 years of history suggesting that banks and insurance companies are good, solid industries, but you're also betting that the current interest rate environment will continue. And to the extent it does, then yeah, actually the banks I think they'll be okay because, they've learned to adapt over the last, decade, but I think it's highly unlikely that will be the case.
No, that's a good transition because it was Mark Rubenstein, his net interest, and he was a guest on the podcast a couple months ago. He said, hey, this is the first time I've ever seen, it was an Irish bank. I can't remember which one, but they were in liquidation and they had to pay someone to take their deposits, right? And traditionally, American banks, if you're an American bank investor, you would generally look at a company and say, hey, I value this bank at tangible book value plus a premium for their deposits based on how good their deposits are. And what this Irish bank was kind of saying was, hey, we're worth tangible book value less a negative premium for our deposits because of negative interest rates, right? So you do wonder, is that kind of adapting to the times and stuff? And I guess we can use that as a transition to kind of talk about your other idea in this issue, which was it was permanent TSB. Is that it?
Yeah, correct.
An Irish bank. And we don't have a ton of time left, but maybe you could just quickly go through why you're so attracted to this Irish bank.
Yeah, so I think the situation Mark was referring to was a French bank that was selling.
Oh, I thought it was Irish. Shoot, okay.
But then he did
European countries confused.
He did talk about an Irish bank in this latest issue, and this is what I touch on too. So I think that's probably where you got that from. But so permanent TSB super quickly trades at 0.12 times book. And what's interesting is it's an earnings issue. It's not a solvency issue. Right?
Yep.
They've elevated non-performing loans, but nothing crazy. The reserving has proven to be really good over the past 5-6 years. But the issue is they just don't make that much money. So their ROE is somewhere in the 2% range. And then obviously with COVID, they've taken provisions that will wipe out the next year or two of earnings, right? Mm-hmm. And so therefore you trade at 0.12 times book. I think what people miss though, and it's kind of like CIT, but the opposite is permanent TSB has these tracker mortgages, and it's more than half of their loan book, and they float off the ECB rate. So ECB rate's minus 50 basis points. So these mortgages only yield, 1.3%. In Ireland, which has the widest mortgage spreads in Europe, mortgages now are more like 2.75%, 3%. So over time, those floating rate mortgages that are, don't yield very much, will roll over and be converted into regular mortgages. So all of a sudden, on half of their loan book, you're picking up, a 2% spread. Right?
How long will it take for them to roll over? I'm guessing, is it kind of decades for them to roll over?
No, it won't be decades. It probably will be over the next 7 to 10 years.
Okay.
And because these were all mortgages underwritten in, call it 06, 07. So they're already, 13 years old.
Yep.
So like, it's just a matter of time. But what's really interesting is I think Ireland is one of the most attractive banking markets in Europe. It's an oligopoly. There's only basically 5 banks, 2 big ones, and then you've kind of 3 smaller. Widest mortgage spreads. That's a long story, but they do. Fastest growing, youngest demographics, and I think the lowest, debt to GDP.
Yep.
And business friendly environment, so on and so forth. It was really interesting.
Everybody used to want to get over there for the tax rate over to Ireland.
Yeah. They still have the lowest tax rate in Europe by far. And what's really interesting is there's a bank, Ulster Bank, and they're owned by NatWest, which is, rebranded from RBS, Royal Bank of Scotland. And it's been an underperforming unit. NatWest's ROEs are somewhere in the, I think, 6 to 8%. This Ulster Bank, it's called, has ROEs of, somewhere between 0 and -1 and +1 for the last 3-4 years. And it's similar issues where, they have these low yielding tracker floating mortgages. And they also get, I think, probably stuffed unduly with some corporate costs.
Yep.
So if you look at permanent TSB trades at 0.1 times book, the big Irish banks trade at 0.3. So I think NatWest is saying we want to wind down this Ulster Bank. We're just going to go into liquidation, similar to what you were saying with the French bank. And I guess they're saying, well, we can, if we sell off our loans, pay down our depositors, we can take out more cash than we would get, via sale. But I don't think that's actually quite right. And I think, without getting too much into the weeds, if you look at the FCNCA deal and you model it into, a permanent TSB by Ulster Bank, all of a sudden you have a similar situation where these 2 banks with, 2% ROEs, in good times, all of a sudden can be a 6% ROE, even in a low interest rate environment, because it allows 2 subscale banks, to scale.
Yep.
And it consolidates the Irish bank into basically, it would be 3 banks plus, KBC, which is kind of like Ulster Bank, just an underperforming, subsidiary of KBC Bank. And then all of a sudden the market share of this combined bank would be 26%. And there's just so many benefits from it. And what's interesting too is that NatWest has a ton of trapped capital. So if they went the liquidation route, which I think would be a bad look for the Irish government could trap that capital for longer.
Yep.
Whereas, you could see a situation, and I've run some numbers where PTSB, could pay up to 50% a book, like just this massive, massive premium. Ulster Bank also has, 26% CET1 ratio. So basically they've double the capital they need. So if the Irish government regulators were willing to work with NatWest, they could say, okay, we'll dividend out half the capital, PTSB pays you half. So all of a sudden they'd be getting 75% a book for something that only pays, 2% ROE at best. But under PTSB, costs could be cut at least 20%. That's not just my number, that's, some analysts as well. And then all of a sudden you have a really attractive bank in an oligopoly market, and the Irish government owns 75% of it. So I think they'd be highly motivated to help a deal like this go through, especially when, like, Ulster Bank's a 120-year-old bank. If they liquidate, they'd be leaving small towns without a bank.
Let me ask you two questions of this. So my first question is, like, you've said, hey, Permanent could pay up to 50% of book value for this company, right? And Permanent, I think they trade for just over 10% of book value. Like, wouldn't shareholders revolt a little bit if they went out and said, hey, we're doing a deal? You're just throwing that out there? You don't think they'd actually pay up that high?
No, I think they could with cash.
Okay. And then the second thing I just wanted to highlight, I thought you had, towards the end of that write-up, you had, I think the merger makes a lot of sense, right? Like, hey, you've got two underperforming banks. If you can take your ROE up from 2 to 6% and you trade for 10% of book value, like, that multiple gets interesting, really, really interesting, right? I think you had a really good comment on why you think permanent merger might be in the cards. Could you just walk through kind of why you think a acquisition could be in the cards in the near term?
Well, I don't know if it'd be in the near term, because this is going to be like kind of like a political battle. The two big banks can't buy Ulster because all of a sudden their market share in commercial lending would go to 100% between the two of them.
Yeah.
PTSB has no presence in the space. And I think it's just as simple as, NatWest has 4.4 billion of euros worth of capital tied up in this thing that isn't making any money. And I think the Irish bank would be highly motivated, like, not to see a liquidation. And so you could see a situation where they kind of say, hey guys, well, we're just not going to let you do that. So why don't we come up with a plan where you can take out your capital sooner rather than later? You merge with PTSB, the government makes back all their money. Because I think the government's break-even price on the stock is somewhere near €4. PTSB trades at 50 cents.
Yeah.
So, like, the government would be highly motivated. I think NatWest could realize the highest amount. At the moment in the press, they're saying that it's much more likely liquidation, but I think is one of those situations where you never believe something until it's officially denied, type of deal.
Yeah, I just if I remember correctly, you said the Permanent TSB was asked about mergers, and he said, hey, I've got a lot of experience in M&A from my Polish banking days. And I thought that was one of those tells to me where it's a really nice check when there's a really accretive acquisition out there and you ask about it and the guy says, oh yeah, I've done acquisitions before. I know what I'm doing here. Am I misremembering that? Or
No, that's exactly right. Exactly right. I think just the deal is, like, does NatWest think they can get more via liquidation? And would the Irish government be friendly if they tried to go down that path?
Yeah.
I think the answer to both is no. But also, like, if I was negotiating, I think my opening salvo would be like, yeah, I'm going to liquidate. So, so we'll see. But it seems highly cheap, and it just points out that, like, good things can happen when you have a solvent bank trading at 0.1 times book. That's fixable. Good things can happen when you have M&A to build scale in the zero interest rate market. If it doesn't happen, I'm still happy to hold Permanent TSB. And I should disclose, I hold Permanent TSB, I hold First Citizens, I hold Bank of Ireland.
I just think it's one of those things. The market can get really focused in on the near-term financials and the near-term things, and you do see over and over, like, it gets focused on this, but there appears to be a very strategic deal that would create value for all sides. The government would save face, they'd make money. Every player involved could make a lot of money, could cut a lot of costs. Like, keep a company alive is no small thing. Like, it just seems like it makes all the sense in the world, and financially it'd be super attractive. So those are the type of thing. I haven't looked at this in depth yet, but those are the type of things that I find betting on, like, can work out really well.
Yeah, and from a regulator point of view, you're taking a bank that's struggling to earn a 2% ROE, and all of a sudden, if it earns a 6% ROE, like, it's significantly safer. Just like, even if CIT does have issues in their CRE lending, as a part of First Citizens, that tail risk of huge implosion just dramatically decreases. Like if you have other businesses that are profitable, are continuing to bring in money, it plugs a lot of holes. So building scale and diversification, from a regulatory point of view makes a ton of sense. I would point out that part of the reason this exists is like, the Irish government owns 75%.
Yeah, so pretty thinly traded and a pretty big
thinly traded. Yeah,
so like shareholder who might not be super economic when it comes to their decisions.
It comes to their decisions, but also, there's not a huge float out there. So, there's not a lot of people looking at it, basically, what I'm trying to say. Not too many people look at the third run Irish bank. But I think it's interesting.
Perfect. I think it's pretty interesting as well. Cool. Well, Tim, anything else we should be talking about? Irish banks, First Citizen, anything else you want to throw out before we wrap this up?
No, I guess the only thing I would say is I think there is opportunities in Europe and the United States for other transactions like this. And if anybody wants to send any examples my way, I'm happy to take a look. I'm currently looking for more.
Look, I agree with you. There's opportunities, and I expect to have those opportunities coming once a month in my inbox through On Beyond Investing. So, Tim, thanks so much for coming on. I'll be sure to, I've really enjoyed my subscription to On Beyond for over 2 years. I'll include a link to it in the show notes for anybody else who's interested in looking at it. You can always reach Tim at the site, and we can go from there. So, Tim, thanks again for coming on, and we'll have to do this again.
Awesome. Thanks so much, Andrew. Always a pleasure speaking.